Hi, I'm Adrian Helfert, CIO of Multi-Asset and Alternatives for Westwood Holdings Group. Thanks for joining us to talk about the markets and the outlook. What a year it's been. As I look to today, December 19th, the S&P 500 is up a white-hot 25%. Over half of that is since Halloween. We've seen pretty exuberant markets. And a big part of the story is that if I remove the top 7 largest names of the S&P 500, the so-called Magnificent Seven, the remaining 493 stocks are only up around 7%. And if we look back to the beginning of November, those 493 stocks were actually down for the year, with the Magnificent Seven being up over 70% on average. Just food for thought. A big driver of the market has been just 7 names. What's driving this? Well, a few things to think about. Artificial intelligence is a thematic or narrative of the markets that's benefited from the mega tech companies. The benefits will trickle down to all, but the initial beneficiaries and the easy response is to go buy large tech companies. That's where we've seen money flowing to express this thematic. Another big area has been the Federal Reserve. The United States Federal Reserve spent most of the year hiking rates as a response to combat inflation. We all know this. We've hiked base rates over 500 basis points since 2022. Bond yields rose pretty dramatically to the end of November. As a result, bond yields rose pretty dramatically till the end of October. As a result, most stocks lagged, those 493, and dividend-producing stocks especially, given the easiness of holding cash that yields 4 to 5%. Geopolitical risk has certainly been a narrative as well. That risk has heightened over the course of the year with both the Ukraine and Russia conflict, as well as now the emerging Middle East conflict, and that's likely to continue, although we've seen much of the initial expression of that risk. Over the course of this year, a move to quality actually pushed some investors to mega cap companies on a concern that smaller companies could feel the pain of financial condition tightening. Now, recently, we've seen some pretty significant change that investors should be aware of. As I said, since the end of October, early November, pretty significant changes have happened and the market has appreciated in areas maybe that you didn't expect. As I said, we've seen that broadening of returns. Equity markets are rising and bond yields have dropped significantly, almost fully retracing their rise from the first 10 months of the year. The signal we see from the US Federal Reserve now is that inflation is dropping. It's not yet at target, and our inflated base rates have done their job, with the next likely move being a rate cut. That's what we've seen most recently. And of course, the markets like a more accommodative Federal Reserve. Lower base rates lead to higher investment in equity markets, lead to higher potential returns in equity markets. That's a positive reaction that we have seen. Now, often, but not always, the rate cut requires a catalyst. So you think a recession. And the Fed hopes to avoid that with a proactive approach. If inflation continues to fall, which may require unemployment to rise, the consequence for market is a positive reaction for 2024, and that part feeds into our outlook. Given the need for companies and somewhat consumers as well to refinance their debt, and their reluctance to do so over the course of the year when we've had elevated rates, higher debt financing in a higher rate environment, a key factor to watch that we'll be watching this year is corporate debt refinancing. Effectively, we need refinancing to happen before a required refinancing wave hits the market in the next couple of years. Just something that we will be mindful of. But for 2024, we're excited about the opportunities that we see of this broadening that I mentioned. That means we see good companies that can participate in improvements in revenue generation, better margins, and subsequently better earnings from economic growth and spending, as well as the technological innovations that have driven those Magnificent Seven. Somewhat the trickle-down effect of those new benefits from artificial intelligence and other technologies helping the remainder of those smaller companies. And it's certainly helped by a more accommodative Federal Reserve, making debt financing of new opportunities a little bit cheaper. Finding and investing in those good company selections are what will drive good performance on the year, and that, of course, is our specialty. So we're excited. Interest rates are likely to fall further, even though it's more likely to be in the near-term maturities. Longer term maturities will depend on the path of inflation, and all of this will depend really on a continued fall in inflation metrics, including wage inflation and service sector inflation, two areas that we will be watching to see if it will change the potential for the outlook. Corporate bonds this year do provide good income. They provide pretty significant income over the past year. The best way to invest is likely going to be looking at newly issued bonds, providing investors like ourselves with that lending concession. We're a lender effectively coming into companies that want to borrow from the market, and we earn a little bit of extra from doing that. We'll find those opportunities and express those. In the sectors, there are attractive reweightings of opportunities given this economic outlook change that we've seen most recently. We do like both the real estate and the energy sector, with attractive valuations and good income deliverance. In addition, select healthcare equipment and software and services companies have attractive valuations and good potential growth, given that broadening of revenue generation and better margins. Just a quick summary. We recently moved from neutral to positive on equity market investments for our fundamental investment funds, primarily on finding good individual investments and sector selection opportunities. Bonds will continue to provide good income for investors, but a little bit lower than before, and push some investors out into equity markets. And bonds have a little bit more uncertainty in their valuation. The valuation in seasoned corporate bonds is less attractive currently. You get less extra compensation for the potential of a default, though there are still good select opportunities that we're finding for our funds. There's much more in a detailed outlook we produce. We would love to hear from you and talk through that if you're interested. Otherwise, thank you for listening and have a happy holidays.